British government is holding a 25% gift for you. But most people throw this money in the bin, not for lack of funds, but for lack of a simple strategy. The secret isn't how much you earn, it's how you use the rules of the game to your advantage. If you ignore this, your retirement could be just a countdown to scarcity. If you understand it, the system works for you while you sleep. In practice, many people simply don't use this benefit, as shown by participation and opt-out data from the pensions regulator. I've seen colleagues opt out of their workplace scheme without realizing they were turning down employer contributions. Let's open the pension black box now. Imagine an investment where you put in 80 quid and instantly receive 100. That's not financial market magic. It's called tax relief. The public sector wants you to save, and it pays you a bonus to do so. Basically, 1 in every £5 in your pension comes from the government as an incentive. As John Bogle highlighted, costs and structure matter more than returns in the long run. Here the gain doesn't come from the market, but from the tax system itself. If you're in the 40% tax bracket, the return on your contribution rises to 66%, according to HM Revenue and Customs rules. It's the only place where HMRC pays your income tax back directly into your pocket. Here's the golden rule for those working today. If you're an employee, there's auto-enrolment. The math is exact. You contribute 5%. Your employer is required to put in another 3%. That's literally free money you leave on the table if you choose to opt out. In practice, this means turning down part of your indirect salary. I've followed cases of people who stayed out of the scheme for years and only later realized the impact on their accumulated wealth. For those earning between roughly $6,000 and $50,000 a year, this is the best deal on the market. There are two main types of schemes: defined benefit and defined contribution. In the first, the risk is with the employer. You receive a lifetime income based on fractions like 1/80th of your salary. In the second, the risk is yours. Your future depends on market performance and management fees. Small frictions accumulate into large effects. Albert Einstein called compound interest a powerful force. The problem is that fees also benefit from this same mechanism. Fees of just 1% can devour about 1/3 of your final pot over 30 years, as demonstrated by the Financial Conduct Authority in studies on investment costs. Recent data shows that nearly 2 in 5 people in their 20s to 60s will struggle financially in the future, according to analyses by the Pensions Policy Institute. Projections indicate a significant risk of insufficient income. The average income today is barely over $17,000 a year. That's low. Too low for the current cost of living in the British Isles. Public systems have faced strains before. After the 1973 oil crisis, several countries had to revise long-term promises. Pensions are not immune to this type of adjustment. The black hole in Westminster's accounts is already in the tens of billions, according to the Office for Budget Responsibility. As Friedrich Hayek argued, centralized systems tend to suffer from limitations of information and planning over time. This includes pension promises. This means you cannot rely solely on political goodwill. And speaking of politics, let's talk about the state pension. Forget the idea that it's automatic. To receive the full amount, you need 35 years of national insurance contributions. If you have fewer than 10 years, you receive zero, nothing. This particularly impacts those who have spent time abroad or had career breaks. I've seen cases of qualified professionals who discovered gaps in their contribution history too late. If you're an immigrant or have gaps in your CV, each missing year can be costly. The current retirement age is 66, but the clock is ticking. It will rise to 67 and then to 68 in the coming decades. Now, the part no one explains clearly: when you reach the age where you can access your pension, you have a fiscal superpower. You can withdraw 25% of your entire pot in one go. And the tax on that? Zero. A quarter of your decades of effort lands in your account tax-free. The rest? Well, then the taxman treats it as normal income. But pay attention to the timeline. The rules for early access are changing. Today, you can access your money at age 55. But from April 2028, the door only opens at age 57. This changes everything for those planning to stop working early. If you want to optimize to the maximum, use salary sacrifice. You give up part of your gross salary before you even see the money. This reduces your national insurance and can even keep you below the 40% tax threshold. If you are a director of a limited company or self-employed, use a SIPP. It's as if your company pays your retirement as a corporation tax-deductible expense. This puts money into your future while reducing your government tax bill today. It's pure tax efficiency without the legalese of high street banks. The system isn't against you. It's just complex for those who don't spend 10 minutes understanding it. Don't wait for the government to decide your standard of living. Take control of your pot. Check today how many years of contributions you have on the government portal. This type of decision may not seem urgent today, but over decades, it often means the difference between financial autonomy and dependency. It's that old cliché. Your future self will thank you for gaining this knowledge. You've just seen exactly how the British system works. Now the question is, do you know where you stand in this game? Most people discover gaps in their contributions when it's far too late. Don't make that mistake. Your homework right now is to head over to the Gov UK portal. Search for Check Your State Pension Forecast. There you'll uncover two critical pieces of data. First, how many springs of contributions you've actually banked. Remember, you need 10 years to get a single penny and 35 years for the full amount. Second, the exact date of your finish line. If you're an expat, self-employed, or have switched careers, your strategy starts with these numbers. Don't ignore the power of tax relief and salary sacrifice. Every pound you don't protect today is a pound the taxman takes tomorrow. If this guide opened your eyes and you want to master the rules London imposes on your pocket, hit the like button so the algorithm knows this content is valuable, and subscribe so you don't miss the next technical updates that save you money. Take control of your pot of gold while you still have the factor of time on your side. Knowledge is the only thing the government cannot tax. I'll see you at the next financial level.